Hi, welcome to this Accofina tutorial. This tutorial today is about who is Mr. Market and price versus intrinsic value. And this is from our fundamental analysis playlist. Okay, first things first, you may have noticed if you've seen another one of my tutorials that I'm using different presentation software. Today I'm using Prezi rather than Keynote. This is the first time I've used it for one of my tutorials, so I'd love your feedback. It's a bit different, so I would have to obviously subscribe to Prezi if I wanted to use this, but I'd love to hear some feedback about what you thought about this different presentation software if you've seen some of my other tutorials. Do you prefer Keynote or do you prefer Prezi? I use less words in Prezi and it's a bit different the way it flows, so please let me know which one you prefer. Okay, let's get into it. So first of all, we're going into the introduction. What are we trying to do today? So what do we want to achieve? We want to help you understand why price does not equal value when it comes to the stock market. Why prices of stocks does not necessarily mean that's how much the company is worth. This is very important to understand the tenet of value investing. Value investing is a stock market investing philosophy that many people are proponents of, particularly Warren Buffett. It came out of the Columbia University and it's very popular if that's how you want to approach your investing. And the final thing we want to achieve is we want to realize the stock market is our servant, not our master. Which it's kind of like a Jedi mind trick that you kind of got to play on yourself, in that you're not at the whim of the stock market, but rather you can take advantage of it. Alright, so since today it's about investing and possible stock purchases, I have to have this disclaimer. Please pause, have a look. I'm just saying that the business, Accofina, and myself, we're not giving personal advice in this video. It's meant to provide factual information for educational purposes, and we don't know your personal circumstances and financial goals. So please have a pause, have a read, make sure everything's clear that I'm not giving personal advice or recommendations here. Okay, so firstly we're going to look at intrinsic value. This is very important when you use fundamental analysis as your stock investment method. Okay, so how do we use intrinsic value to invest wisely? Now, intrinsic value is what the company is worth based on its operations and financial position. Stock prices are the prices that people are exchanging ownership of that business. And these are not the same concepts. They're different. So intrinsic value is what a company is worth. Stock prices are what people are exchanging ownership in that company. And they're not necessarily the same concepts. I know I kind of just repeated myself, but I hope the point of this story, the point of this tutorial is to help you understand why that does make sense. Now, fundamental analysts have a simple rule. They buy when the price is lower than intrinsic value, and they sell when the price is greater than intrinsic value. So does that make sense? So if the company is worth X dollars, and the price is lower than that, then it would make sense to buy because now you're getting something at a bargain, at a discount. It's really worth X dollars and you're paying less than X dollars. And on the flip side, you'd sell. If the company was worth X dollars again, then if the price is above, then you're selling something for more than it's really worth. Does that make sense? Okay. And there's a key idea is that prices tend towards intrinsic value over time. It's about not getting emotional about short-term swings because intrinsic value kind of is much more stable than stock market prices. And eventually swings reverse themselves. So intrinsic value changes slowly, stock prices change rapidly, and over time prices tend towards intrinsic value with wild gyrations that often revert back to themselves. There's a famous saying that I think it was Warren Buffett. He said that, or actually I'm not sure, it could be someone else, but the saying is, in the short run, the stock market is a voting machine. In the long run, the stock market is a weighing machine. In the short term, it's a popularity concept, but in the long term, it's company operations, company results, and the financial positions that determine stock prices. Okay, so let's get on to Mr. Market. Now, Mr. Market and the story of him, it's very famous, very important. Warren Buffett talks about it all the time. It was a parable created by Benjamin Graham, which personally I first read in The Intelligent Investor. I don't know if he used this analogy before The Intelligent Investor, and it explains why people shouldn't rely on stock market prices to value businesses or value their stock holdings. So before we get into this, let's just have a look at who Benjamin Graham was. So Benjamin Graham was considered the father of security analysis. He helped make stock market investing mainstream. Prior to Benjamin Graham and his heyday, people really only kind of invested in bonds. Stock market investing was considered highly risky, highly speculative, kind of akin to gambling and not knowing. It was Benjamin Graham who developed a system that you could actually use that made stock market investing as reliable or analytical as bond investments. His nickname was the Dean of Wall Street. He wrote 2 seminal books. He wrote Security Analysis in 1934 and The Intelligent Investor in 1949. The Intelligent Investor is a smaller book and easier to read, and is what Warren Buffett says changed his life, reading The Intelligent Investor, and helped him make his fortune. Benjamin Graham founded the New York Society of Security Analysts, which has now become the CFA Society of New York, and they were the first provider of the CFA exam. So if you're interested in investment management and fundamental analysis, you may be interested in the CFA Institute. It was Benjamin Graham was one of the founding fathers of it. Now, he was also Warren Buffett's professor at Columbia University and later Warren Buffett's employer at the Graham-Newman Partnership. Okay, so that's Benjamin Graham. Let's get back to the story of Mr. Market. Okay, so this is my paraphrasing of the parable. It's written different in the book, and I'm not just going to copy and paste what's in The Intelligent Investor. So this is my twist on it. Now, you and Mr. Market are partners in a business venture. You both invested $5,000 of your own money to get your own shares in the business. So you have $5,000 worth of shares in this business. Mr. Market has $5,000 of his own money to purchase shares in the business. But Mr. Market has a unique behavior. He does this every morning. You work in the business, you're all fine, you get along well, but he has this very peculiar behavior that he does each and every morning when he arrives at the office. He's done the same thing every last day for the past 15 years or however long you've worked in the business. Without fail, he arrives at the office, opens the door, walks in, sees you, and depending on how he's feeling that day, he reckons he knows what your share of the business is worth. He knows what your 50% ownership of the business is worth that particular day. And he's determined to tell you. He's determined. He wants you to know what your share of the business is worth. He analysed it after you both went home the previous night, and he's got this new valuation each and every morning, and he wants you to know about it. But there's also something else. He's also determined to deal with you every day. So even though he's told you the valuation he thinks it is, he's also willing, at that particular time, first thing in the morning, to buy your shares in the business venture for that particular price that is determined, or on the flip side, he's willing to sell you his share in the business for that same valuation. So do you see what's happening here? He does this each and every day, every morning, day after day. Comes in, tells you what the business is worth, and by default, what your share in his share is worth, and then he will ask, do you want to trade with me today? He says, do you want to buy my share of the business, or do you want to sell me your share of the business? Okay, that's our basic premise. But here's the twist. Mr. Market has these weird moods. Some days he comes into the office, and the valuation he gives you and the offer is fair and reasonable. But there are some other days where he's completely high-strung. He's emotional and he's highly irrational. 50% of these weird emotional days, he's hyper-confident, acts like he's bulletproof, so sure of the success of the business. He's just super confident. And the other 50% of the days, he's in a real funk. It's almost like he didn't get enough sleep, had too much coffee. He's in a real funk. He's acting like Chicken Little, like the whole world is going to collapse in itself. And these are these weird days. So half of these weird days he's hyper confident. Half of these weird days he's acting like Chicken Little. And these come around every now and again. So sometimes he's very unreasonable. Sometimes he's a bit of a he's a bit weird. So if he's in his crazy optimistic and highly confident mood, he values your share of the business as extraordinary high levels. Like you hear him and you just go, "Oh, Mr. Market, jeez, I don't know if my share of the business is worth that much." He's determined that he wants more of the business at almost any price. He's so confident of this business, he wants more. He doesn't want to own 50%, he wants to own 100%, and he'll pay almost any price to get it. But if he's in one of his crazy pessimistic moods and he's highly depressed, then sometimes those days he values your share of the business venture at extraordinary low levels. So it's the flip side. This time he's so fed up, he's so Chicken Little, he's so depressed, he just wants out of the business. Just wants out of the business any price. He's begging you to buy his share of the business so he can get out. And that's the short story behind Mr. Market. We have this guy, he can be emotional sometimes, and he's constantly has this peculiar habit of wanting to buy in and out of your business venture that your partner's in. So what are the lessons here? What are the lessons from working with Mr. Market and this partnership? You've invested your $5,000 in the business venture. Like, you've been working on this business for a while. You know this business. You know how it's performing very well. You think you know what the business is worth. And essentially, what do you think the business is worth at any point in time? Would it be based on cash flow and assets in the business today? How about the dividends you can draw out in the coming years in this business? Is it based on the business operations, future profits, and other accounting information? Or is it based on this emotional guy that has too much coffee, Mr. Market? Is it based on what Mr. Market says it's worth each and every morning? The moral of the story is, at what point do you stop listening to your emotional business partner and start believing that you know what your business is worth based on your expertise and research and knowledge of this business? And this is where true investors come into it. A true investor knows that stock price fluctuations serve only one purpose. A true investor knows that stock price fluctuations only provide opportunities to buy when prices are excessively low, and a stock price fluctuation only provides opportunities to sell when prices are excessively high. And at all other times, it's better to forget the stock market altogether. You should worry more about the business operations and any additional income returns such as dividends and so forth. It's better to... You don't need the stock market at 24 hours a day, 7 days a week. The idea is the purpose of the stock market is to take advantage of it, not be pushed around by it. You can engage and trade with Mr. Market when he's being emotional or irrational, otherwise let him be. He can do his own thing, he still pulls his weight in the business is successful or not, you know that very well, and that's the way it should be. Stop paying attention to what Mr. Market thinks and pay attention to your own opinion and knowledge and research into the business. And the stock market is the same thing. The stock market is representative of Mr. Market. All it does is it constantly spits out opinions about what it thinks shares are worth, and the only times you should really engage with it when prices are excessively low and you buy, or when prices are excessively high and you sell. Other than that, better just to ignore it and focus on the task at hand, which is working your business and trying to improve the overall success of your venture. Alright, so let's talk about modern day Mr. Market. 21st century Mr. Market. Now, Mr. Market was an analogy developed in 1949. Back then, only the newspapers, which came out once a day or twice a day, radios, which were only listened to possibly in the evening and so forth, and stock tickers could let Mr. Market get a hold of you and get a hold of your emotions and getting your girl. Even the exchanges, the stock exchanges, were analog, and there was limited access. So there was no digital pricing. You couldn't get it on your iPhone app. The prices, you basically had to call a stockbroker, and he would give you a price at one point in time. So even in 1949, it was hard dealing with the emotional whims of Mr. Market. But in 2018 and 2019, we've got a ton of other things to deal with. We've got the internet and all the variety of data that can swamps our surroundings and our environment. We've got mobile phones. We've got Twitter, stock tweets. We've got apps that tell you the prices jumping up and down. We don't get one price a day or a few prices a day. We can literally stare at a screen and watch it bounce around like 24/7 across every single market across the world. We've got social media. Oh, gee. This one's my beef. The irrationality you'll find on stock market groups or some financial social media outlets. I don't know if they're inexperienced or don't know much about Mr. Market, or they're trying to manipulate people's moods for their own reasons and trying to talk things up or talk things down. But often it's hard to escape the reaches of Mr. Market when you're got a lot of apps and social media apps in front of you. Now we've got electronic signage and billboards. Sometimes you're even at the train station and there'll be stock tickers running across like some sort of news bulletin or something like that. So it's hard to escape Mr. Market there. You got online and app broking. So no, it doesn't take 10 minutes of the day or 20 minutes of the day to call your broker. This time you can jump on an app, go on your computer and deal with Mr. Market very, very quickly and multiple times a day. We've got HFT and algo trading. This time, Mr. Market the markets don't even move according to what people decide. Often, it's computers bouncing things around and pushing all of our buttons, like even with no human input whatsoever. You've got thousands of investment products. Everyone's trying to sell you something, and there's a wide variety of investment products compared to 1949. And there's also your 24-hour financial media networks, and we're told that we've got to keep up to date with the markets and be in tune with what's going on. But geez, if you listen to these too much, often it's hard to know when to disconnect from it. I'll bring up Warren Buffett again. That's kind of why he enjoys being in Omaha, where he does his business. He likes being far away from Wall Street, so he hasn't got the 24-hour bubble going on. The moral of that modern day is even harder to deal with Mr. Market nowadays, and knowing Mr. Market and his irrational moods and how you should view price versus intrinsic value, and about how you should only deal with the stock market when it's advantageous to you and not be pushed around by it, is even more important today than it was back in 1949. Okay, so let's wrap up. Let's talk about what we covered today with an introduction. We talked about how intrinsic value and stock prices are different concepts. We talked about understand the tenet of value investing. We talked about intrinsic value, and we buy when prices are below intrinsic value, and we sell when prices are above intrinsic value. Then we went through the story about Mr. Market in being your irrational business partner. We talked about the lessons about how we should ignore Mr. Market and only trade with him when we feel it's advantageous to us. And then we talked about the modern day, how it's even harder to be poked and prodded and pushed around by Mr. Market with modern technology. Okay, so that's it. Best of success. Well done. Thanks for your time. I'll just talk about this Let's Grow Together tab. And please, if you enjoyed the video, please share or subscribe to my channel. Watch another one of my tutorials now, and please comment, and please give me this feedback about this presentation software. I'd really like your feedback. Do you prefer the keynotes from the Mac software, or do you prefer the online Prezi presentations? So do any of these now. Share, subscribe, comment, or watch another, and thank you very much for your time.